There is plenty of capacity in the overall marine market, says Henry Veguilla, Vice President of Marine Distribution for Liberty International Underwriters and Marine Division. But for those marine companies with exposures like wind or offshore drilling risks, finding enough coverage is still a challenge. In this video with My New Market's Amy O'Connor, Veguilla discusses how the company can use the results of its recent LIU Marine Risk Manager survey to help insureds understand what steps they can take to secure sufficient coverage at a fair price.
It's kind of paradoxical because there is a lot of capacity. It's just in what segments and sectors and to what exposures that capacity is being put to use. So for example, for this particular sector, wind coverage is really, really important. And what's happened is because of the technology and all the equipment and the fact that these folks have grown so much, the equipment is much more expensive. When the losses do happen, the limits they require for protection are so much higher, insurance companies are then far more cautious on how they apply that capacity. So one way that insureds, the client, can help that is by really sharing a lot of information to allow us to properly then assess the risk and price it, and that doesn't always happen. Insureds then still have to go on about the business of what they do. So they get insurance, they protect themselves. If they don't feel it's sufficient, what's been happening, for example, in this sector is that companies are raising their self-retention rates, which means they're basically self-insuring more. So that puts strains on, their balance sheets and their assets and all that stuff, but is one way that they're doing it. They're creating their own self-insurance captives to protect themselves, but those are some of the things they're doing.
Veguilla says every risk in this class has to be closely scrutinized. The more insureds work with the insurer, the more protection they will have.
What we do is highly, highly specialized. It requires underwriters, again, that are basically embedded with these risk managers and fully understand the businesses these folks are in. So we're not a one-size-fits-all. It's not a cookie-cutter product. It's not auto insurance. It's not homeowners insurance. So really, the challenge for us is we really look at every risk individually, standalone, which is why, again, that partnership is so important. So, I can't really specifically tell you what, the way we work it is we look at each account. The better the information that's shared with us by the insured, the more transparent they are, the better we can then offer a solution that makes sense for them. I think we could do a better job at probably laying out how the different pieces come together when we ultimately price one of our policies. So there's work that we can do there to improve that. The collaboration thing is key. So our risk engineers frequently will go on site, visit with risk managers, try to get a better understanding of what's happening at these businesses. So one of the things we can do is look at our database of information and come up with ways, without violating confidentiality, of then providing some of that information back to our insureds in ways that allows them to improve their operations. And then technology. We're using technology in ways that we couldn't use before to help insureds avoid or minimize risks. So for example, with GPS and other technologies, we put information in a database as to where a rig might be in the Gulf of Mexico, and based on where a hurricane is projected to perhaps go, the better we get at projecting these things and giving them lead time, they can then move things out of the way so that when the hurricane does come through, the damage is not as great as it would have been if we hadn't given them that kind of information. And they're doing that for themselves too.